Your neighbour thinks you're doing well. Your parents think you've made it. Your LinkedIn says senior manager. Your salary says $150,000 a year. And every single Sunday night, you lie awake wondering if you can cover the mortgage this month. That's not a personal failure. That's not a budgeting problem. That is Australia in 2026, and nobody is talking about how badly the maths has broken down. Let me paint you a picture. 2 households. Same city. Sydney's inner west, let's say. 20 years apart. 2004. Your parents' generation. Combined household income, $80,000 a year. They'd buy a 3-bedroom home in Marrickville for $380,000. Mortgage repayments eat about 28% of their take-home pay. They still have enough left over to go to dinner on a Friday, save a little, and take the kids to Noosa every January. In 2005, combined household income, $160,000. That same Marrickville house is now $1.7 million. Your mortgage repayments eat 62% of your take-home pay. There is no dinner on Friday, there is no Noosa. There is just surviving in a house your parents could have bought twice over with one income and a handshake. That is not a lifestyle problem. That is a generational wealth heist. And it was done so quietly, so incrementally, that most people still blame themselves for it. I need to say something directly to you. If you're earning 6 figures and still feel financially trapped, you are not bad with money. You are not lazy. You are not spending too much on coffee. You are living through the single greatest divergence between wages and asset prices in Australian post-war history. The rulebook your parents handed you, study hard, get a good job, the money will follow, that rulebook worked when houses cost 3 times your annual salary, not 13. You're not failing the game. They changed the rules of the game while you were still learning how to play it. And the worst part? Nobody told you. The financial advice industry, the property sprokers on Instagram, the mortgage brokers who smiled across the desk and said you can make it work, none of them sat you down and said, "Mate, the system you were promised no longer exists. So before we go any further, let that guilt go. Put it down." Because what we're about to talk about requires clear eyes, and you can't think clearly when you're busy blaming yourself for structural failures that started before you even entered the workforce. I want you to imagine, or maybe remember, a specific Tuesday night. It's 8:43 p.m, the kids are in bed. You've just done the weekly budget review, which is a fancy way of saying you stared at your CommBank app until your eyes blurred. Your partner is across the kitchen table, and there's this silence, not a peaceful silence. The other kind, the kind where both people are thinking the same thing, but neither one wants to say it out loud first. Because saying it out loud makes it real. You're both thinking, we earn really good money, so why does it still feel like this? Maybe one of you finally breaks and says something like, maybe we shouldn't have bought the car. And then there's that flash of something across the table. Not anger exactly, but something adjacent to it, because the car is just a stand-in. For the holiday you put on the credit card. For the private school fees you're not sure you can keep affording. For every decision that seemed reasonable at the time, because that's what people at your income level are supposed to be doing. This is the quiet violence of lifestyle inflation, not the dramatic blow-up, not the emergency, just that kitchen table. Tuesday night, 2 people who love each other, slowly calcifying under financial pressure neither of them fully understands. Because here is what they don't tell you about a $150,000 salary in Australia. The ATO takes somewhere between 30 signed 39s and $43,000 of it before you ever see a dollar. Medicare levy on top of that. If you have private health insurance, and you'd better, because the Medicare levy surcharge will sting you if you don't, there goes another $4,000 to $6,000. You're already under $100,000 before you've paid a single bill. Then, the mortgage. In Sydney or Melbourne, if you bought anything remotely livable in the last 5 years, you're looking at $4,000 to $5,500 a month. Per month. That's $48,000 to $66,000 a year. Gone. Groceries for a family of 4? That used to be $200 a week. It's now $350 to $400. The IGA doesn't care about your LinkedIn title. Utilities. Childcare, which in Australia is breathtaking in its brutality. Up to $2,500 a month per child before the subsidy kicks in. Petrol. Insurance. The rates notice. The strata fees. The school excursion your kid handed you a note about this morning with that specific look on their face. Add it up. Do it right now, honestly, without softening any of the numbers. You'll find that a $150,000 salary, after tax, after the compulsory costs of a modern Australian life, leaves you somewhere between $800 and $1,400 a month of actual discretionary income. That's it. That's the number your sense of success is built on. $800 of breathing room, and the car just made a noise it shouldn't have. Here is what nobody tells you. The wealth gap in Australia is no longer primarily about income. It is about assets. And more specifically, it is about when you acquired them. The people who are genuinely comfortable at your income level, almost none of them got there through salary alone. They inherited equity. Or they bought property before 2012. Or they had parents who transferred wealth quietly. A helping hand on the deposit, a company car, a family trust that the ATO treats very, very kindly. The system in Australia was explicitly designed through negative gearing policy, through capital gains tax discounts, through the way super was structured for older generations, to make assets accumulate wealth faster than wages ever could. And here is the trap they designed for you specifically. They dangled a salary number that sounds like success, $150,000. That's the number that makes your relatives relax at Christmas. That's the number that makes your friends assume you're sorted. That number carries social weight. And that social weight is the trap, because it makes you spend like you're sorted. The car lease, the apartment renovation, the interstate trip for a friend's 40th that you absolutely cannot miss. Not because you're reckless, but because you have built an identity around a number, and that identity has monthly repayments. Meanwhile, the wealth gap between you and genuine financial security isn't a salary problem, it's an asset problem. And you've been so busy performing financial success that you haven't had the margin, financially or psychologically, to start actually building it. This is the trap. Earning enough to look wealthy, but not wealthy enough to be wealthy. Okay, let's talk about what actually moves the needle, not theory, not American financial advice with a Sydney filter slapped on it. Real, mechanical steps inside the Australian system. First, understand your super like your life depends on it, because your retirement literally does. Most Australians, including high-income earners, treat their superannuation like a direct debit they don't look at. That is an extraordinary mistake. At $150,000, you are getting roughly $16,500 in employer super contributions per year. But here's what they don't tell you at the water cooler. You can make concessional contributions up to $30,000 per year total. That's an extra $13,500 you can salary sacrifice into super at your marginal tax rate being lowered to 15% instead of your 37% to 45% marginal rate. That is not a subtle difference. That is the government handing you a 20 to 30 cent discount on every dollar you put away. And most people aren't touching it. If you're not salary sacrificing into your super right now, that's the first phone call you make tomorrow. Not next quarter, tomorrow. Second, stop trying to build wealth with what's left over. Build wealth first, live on what's left. This sounds simple. It is not emotionally simple. But here is the mechanical version. Set up an automatic transfer on payday. Not to savings. To a low-cost, diversified ETF through a platform like Vanguard or BetaShares, the ASX 200, global equities, a simple split. Before you pay the cleaner, before you transfer to the joint account, before you even open the CommBank app, money moves. The number doesn't have to be dramatic. $500 a month, left alone in a broad market index fund, at historical Australian market returns, becomes something that starts to feel like a second oxygen tank. Not immediately, but the feeling of waking up and knowing that money is growing without you. That is not a financial outcome. That is a physical sensation. It is the chest loosening slightly. It is the Tuesday night silence becoming something almost peaceful. Third, get honest about the difference between a spending problem and a structural problem. Not every financial issue is a latte problem. Some of it genuinely is structural, the mortgage, the childcare, the taxes. You cannot cut corners your way out of those. But some of it is the car, the subscriptions, the $180 sneakers you bought because you were stressed. I'm not judging, I understand the sneakers. That was cortisol, not desire. But understanding why you're spending is the part of financial therapy that the budgeting apps can't do. When you identify your stress spending triggers and replace them with something that costs almost nothing, a walk, a podcast, a coffee made at home on a Saturday morning with nowhere to be, you don't just save money. You break the psychological loop between anxiety and consumption. That loop is costing you more than any single line item in your budget. Fourth, understand negative gearing and decide whether it actually makes sense for you. Australia's negative gearing laws allow you to deduct investment property losses against your income. At your tax bracket, that deduction is genuinely valuable. But, and this is the part the property brokers gloss over, negative gearing only helps you if the property grows in value. If it doesn't, you're subsidizing a loss and calling it a strategy. Property can absolutely be part of the picture, but go in with clear eyes. Model the actual cash flow. Don't let a mortgage broker tell you what you can borrow. Figure out what you can borrow without feeling that Tuesday night silence getting louder. Fifth, use the tax system like it actually exists. High-income Australians chronically overpay tax because they don't engage with the system. Work-related deductions. Investment property deductions if applicable. Income protection insurance premiums. The ATO is not your enemy, but it will absolutely take everything you don't claim. If you don't have an accountant who specialises in investment and high-income strategies, not just someone who lodges your return, that changes this year. The fee pays for itself, multiple times. Here's the honest ending. $150,000 in Australia is genuinely a good income. I'm not going to pretend otherwise, because that would be dishonest and you deserve honesty. But it is not the income it was promised to be. It is not the income where the maths automatically works out. It is not the income where you wake up on a Tuesday and feel financially secure without effort. Not in this market, not with these asset prices, not with this tax structure. What it is enough to build something real. If you stop performing success and start engineering it, the difference between the people at $150K who feel trapped and the ones who feel like they're building something, it's not discipline, it's not sacrifice, it's not waking up earlier. It's understanding the actual machinery of the Australian financial system, the super levers, the tax settings, the ETF compounding, and pulling the right handles in the right order. That's it. That's the whole secret. No app, no guru, no property seminar at a hotel in Parramatta with lukewarm sandwiches and a whiteboard. Just the machinery, understood clearly, used intentionally. You've already done the hard part. You built the income. Now let's build the wealth.